Hi, and welcome back to ABG Investor Days. My name is Julia Sundvall, and I'm an analyst here at ABG. With me here today, I have Marcus Holmström, CFO of Green Landscaping Group. We will start with a short presentation, followed by a Q&A. Please go ahead.
Thank you, Julia. Warm welcome everyone in the room and also online today to this presentation. Before I jump in to present what Green Landscaping is all about, a brief introduction who I am. I've been the CFO of Green Landscaping Group since December last year. I started my professional career as an auditor at Ernst & Young, where I focused on global and publicly traded companies. Following my tenure at EY, I joined AFRY, an engineering consultancy company, where I've held several leading finance positions over the past 10 years, latest as head of corporate control and investor relations. And before that, I also served as divisional CFO, overseeing a division with 7 billion in sales and 4,000 employees. But I'm here today to present Green Landscaping, as said, where I'm CFO and have been having that privilege since December last year. So what is Green Landscaping all about? It's a home of entrepreneurs. We are a company that provides landscaping services in our cities. An example of services that we provide are snow removal, tree pruning, empty bins in the cities are example of what we do, but we also design, plan, and execute public areas in our cities, such as playgrounds, market squares, and also parks. In other words, we are dedicated to support our local communities in making the cities better, greener, and more livable. And today we're very pleased that we have a group with 7 billion in sales, and we have industry-leading profitability, and we have just getting started. An investment in green then, what does that mean? That means that you would invest in a well-managed company that operates in a very attractive market. We have built it based on a fit-for-purpose business model, and we boost our growth and value creation through a proven M&A strategy. And let me talk more about these three different areas. Our business model is that we operate in a decentralized world. Being an entrepreneur is a central concept for us at Green Landscaping Group. We have about 56 different entities inside the group operating in 6 different countries: Sweden, Norway, Finland, Lithuania, Germany, and Switzerland. All of these operating almost all of them operating under their own local brands. And just imagine to have 56 very well-educated, knowledgeable, and motivated entrepreneurs working hard 5, 6, 7 days a week, providing the end result for our customers. That is the situation we're in, and we're very proud of it. And with this mindset, the company also, we can act agile, make quick decisions, and stay flexible to secure the profitability level that we're operating on today. But we are a decentralized organization, but we're also taking the benefits of the knowledge we possess within the group. So we have the best entrepreneurs, the best companies in our industry. And as always, we strive to become better. As you can see on the slide here, we transparently show the profitability level and size of all our subsidiaries within the group. And the vast majority of them exceeds the industry average profitability. And we know that we can continue to improve all of these ones to even get better. We launched a project back in 2023 in order for us to really take benefit of the competence that we possess in the group, where we have investigated and looked into the building blocks of our company, so we can share knowledge in a much better manner than we've done in the past. This knowledge sharing will drive improved profitability for us going forward, and it's not only focusing on daily efficient measures, it's also about the strategy going forward. Our ability to rapidly improve companies is a crucial part of what we do within the group, and you will in the later slides see how the profitability have improved over the years. M&A is a central task we do at Group. As said, we use it in order to accelerate our growth and value creation for our shareholders. We have today 56 groups. We did our latest acquisition last week in Germany. We are aiming to complete around 10 acquisitions each year. And as we will grow bigger, this target will also increase over time. Since we are operating in 6 different regions, we have a very big pool to choose out from. And when sourcing new companies, we have a list of roughly 50 criteria that we go through in order to look at the company's performance. But the most crucial one for us is the financial performance. And why is that so important? And that's because we are looking for companies that are stable, that don't deliver too high of organic growth, that have a stability in their profitability, or actually improving profitability in a steady pace, because we like stability in the company. The sweet spot company we're looking for is around 100 million in sales and 10% EBITDA. But it's not only about the financial performance. Since we are also a group, as said, of 56 entrepreneurs, we are also looking a lot into the culture and who is leading the company that we're looking into. Because this leader will be part of clusters within our group, and they need to coexist on the same market. So having great people inside the company is a true asset for us. From a transactional point of view, when we do our acquisition, we stick to this discipline approach, and we pay around 5 to 6 times EBITDA level for the targets. And as said, the goal for each year is roughly around 10 to 8 transactions per year, while considering our capacity constraints. And when we refer to capacity constraints, it's not only what our cash flow allows us. We are also looking into our ability to onboard these companies to our structure, as well as making sure that we have capacity to do the M&A deals. And the market that we're operating in. So first of all, it's a very large market. When we look at it from the 6 geographies I referred to previously, we assess it to be 350 billion in annual sales. And it has steadily been growing with 4% over the last years, over a long period of time. Around 65% of our sales come from government and municipality contracts, which gives us strong predictability and financial stability. Our business is low in cyclicality, so we're not heavily affected by economic down and upturns. We are working with long-term contracts, and typically they run for 4 years, or with an option to extend for 2 additional years. And as a base, we benefit from megatrends with urbanization as a key driver. As more people are moving to the cities, the demand for our services increase. But we're also assisting our customer in coping with effects of climate change, where we are part of the solution. And then the slide I referred to previously in the presentation, our financial performance over time. The group was established back in 2009, and we have grown through strategic acquisitions since. Early on the journey, we were struggling with the profitability. And our current CEO, Johan Nordström, joined back in 2015, and since then we have tenfolded in sales and improved our margin at the same time. And we have actually, for the past 3 years, exceeding our financial target of 8% EBITDA level. The improvement in our margin is, of course, a result of our hard work, but built on the decentralized organization and disciplined M&A agenda. But not only looking at top line and bottom line, we have a very stable cash flow generation. It has grown over time as our profitability has grown, but we are in general a light asset business, and we are tying very limited capital to the business we do. We have strong predictability in the operating cash flow, which allows us to be flexible when it comes to M&A, and it's easy for us to maneuver our leverage position, which is one of our financial key financial targets, but that we monitor. And going to the financial target, financial leverage, we are currently at 2.6, and we have, as you see on the graph, been on this level stable over time. And that's the level we deem to be healthy to create the maximum shareholder value. And it gives us also good headroom in our financial covenant in our debt loan agreements with the banks. And if steady state would mean that we would deleverage from these levels through operating cash flow. So before I conclude the presentation, I will focus a bit on the Q1 performance as we just released it a few weeks back. In Q1, we faced mild winter conditions, the mildest winter condition we've seen over the past 15 years. Snowfall impact, when we have limited amount of snowfalls in Q1, that impacts our financial performance. Sales were down 12% and margins were cut roughly in half, ending up at 3.2%. Being an outdoor company, of course, we're affected by the weather, but that's specifically tied to Q1 performance. And with the condition we faced this year, we're of course not pleased with the result that we delivered, but zooming out and comparing it to the conditions that were similar to these ones back in 2020, then the group made losses, and today we generated profit, but I will come back to that as well. We're pleased to see that the cash flow generation continues to be stable with a rolling 12 months cash flow at 532 million. But digging a bit into the snowfall and just making it a bit clear what I refer to when we say we're happy that we're doing better than 2020, but not saying that we're pleased with the outcome of Q1. But back in 2020, how our business works, of course, we're dependent on how much the total amount of snowfall comes. But we tend to earn our most profitable contracts is when we have great amount of snowfall. So we're looking at when we have days with snowfall exceeding 5 centimeters, then we are in a good position in Q1. This year we were significantly below the previous years, and we are on average similar to 2020. And as I said, at that point we made losses of 90 million, and today we did a profit of 40 million in the quarter. The group has grown, but it's significantly due to improvements we can see in segment Sweden that were action that was put into force back in 2020. And of course, I want also to emphasize that in light of climate change, we see that these conditions will be more common going forward. But from a standpoint of view of green landscaping, that's beneficial for us because that will extend the season for traditional landscaping and ground maintenance services, which are very profitable for us in the traditional season. So that the winter become shorter is not really something that is negative for us in the long run, even if it's not good for the climate. And concluding a slide from my end, our financial targets. We have a target to deliver 10% growth each year. We fell short on it last year. We had 9% in total growth. Adjusted for currency effects, we were at 10%. But it was a result of that we put a bit on the M&A agenda on brakes back in 2023 when the inflation rised and so did the interest rates, and we were more cautious towards M&A at that point. But when we felt that we got the signals that we could keep the profitability level on the levels that we saw, we continued to execute the M&A agenda we started to execute on M&As back in end of 2023 and continued throughout 2024. So we expect that this should continue to be above financial targets going forward. On the margin perspective, we're very pleased to see that we achieved our financial target for the third consecutive year. We're of course not in relative terms seeing the margin decline compared to 2023 as a positive thing, but have in mind that we faced larger market headwinds back in 2024 than in 2023. And now we're getting signals about the market being a bit as we saw in 2024, and hopefully it will shift at the end of the year and going into 2026. And from a capital allocation point of view, we have maneuvered our leverage being around 2.5 over time, which we, as said, deem to be the level we should be at in order to create the best shareholder value. So all in all, as I said, we are a well-managed company operating in a very attractive market. We have 56 really good entrepreneurs doing the work every day, and we are growing with industry-leading profitability. So we are on a good path to realize our vision to become the European leader. And with that said, I will open up for questions.
Thank you. So I would like to start on the M&A. You announced your first acquisition of the year last week. Yes. Going forward, how does the pipeline look?
No, but good question, and we were very pleased to tick off the first acquisition this year. Last week, the Wagner in Berlin. We stick to the target that we set out in the beginning of the year, and that reflects in the pipeline that we should be able to achieve 8 to 10 acquisitions this year. From a focus point of view, us entering in the German market in 2 years back, that is where we see that we're putting most focus on currently.
Yeah, perfect. And the market, one of your strengths is that you have a very stable market with around 4% CAGR. How do you see the market evolving in the coming 5 to 7 years?
Oh, but I really like that question, because when we see it that it will continue as is. And stability is something that we value in this situation, that we, despite everything going on and with geopolitical turmoil and so on, we don't see any direct effect on us. But of course, there are indirect effects. But the capital allocation to our customers seems to not be impacted by it. And if we stand here, I see the market to continue on the path it is, growing with 4%.
Yeah, perfect. Do you see any changes in the customer behavior? You have a large part of public customers. Do you see any changes in if it's maintenance or landscaping, or what do you see?
We don't see any major shift to the customer's behavior. We, however, see, and we have seen since middle of 2023, an increased competition in the landscaping market. I think that's a result of the construction market being weak as it's been. So we have had for a time increased competition for players in that segment, but we don't see them to be long-term in our industry. So when their own market pick up, that situation will improve.
Yeah. And the order book was flat Q1 to Q4.
Yep.
Do you see any trend or difference between countries or any segments?
The order book itself has been quite stable when we're looking at all the regions. Then, of course, it tends to fluctuate between quarters. So we also highlight that when we disclose it, that you shouldn't draw any short-term conclusion based on the fluctuations sequentially. But over time, it should be stable and growing. But of course, it was a bit down in Q4 and was stable in Q1. So yeah. It's good.
Perfect. And you talk a little bit about the competition. But how is the competition? How has it developed? Do you see any trends that have become permanent?
No trends that has become permanent, but we still see the players I referred to, that they are still bidding for the bids we're bidding, then of course we have learned to live with it. So it's not that we see any significant change in our ability to win projects, but they are there and impacting the competition. But we still deem it to be short term.
Yeah, perfect. And as you said, you recently released your Q1 report, highlighted a stable market overall, some challenges in Norway, good performance in Sweden, and good activity in the rest of Europe. In Sweden, there's been a couple of challenging years, partly due to a project that is now terminated and a tough market. You have made some changes here. What changes have you made, and what kind of effects does they have?
Yes, also a good question. We saw already back in last year that we didn't get the effect that we wanted after that contract was terminated, and it was specifically visible in Q4. Actions were thereby addressed, and example of those are that we changed the leadership in some of the subsidiaries, but we also put in actions into force of looking at what type of projects are they addressing, how can we drive efficiency measure in their daily execution based on the knowledge that we share within the group. But we have also made the tough decision of discontinuing a few of the operations that we don't think we will get back to the levels that we expect. Yeah. And that will be visible during this year. And we see that now the Q1 was affected by the winter, but the underlying performance, we see that we follow the plan we set out, and we should see incremental improvement during the year.
Yeah. And on Norway, as you say, it was a weak quarter, but you have both snow removal businesses in both Sweden and Norway. Both of them lost about 20% organic growth, but Sweden had much more stable margins. How is the difference?
Yeah, that's also a good question. But to frame it, the portfolio of companies is a bit different in Norway than you compare to Sweden. We have very profitable snow removal contracts in Norway. So if we zoom out over time, we want to keep them in a few of the subsidiaries. Then we were not at all happy with the general outcome of Norway. We should have been able, specifically in the other companies, drawing the advantage of the mild winter conditions. So we are addressing the cost base similar to what we did in Sweden, making it more flexible, but also looking in how can we plan better for this type of conditions. So we expect to see improvements with these conditions when it occurs next time.
Perfect. And looking forward this year, does the early spring, does it affect the rest of the year?
They are somehow interlinked a bit, that depending on how our customers spend their budgets. So if the mild winter, then our customer tends to save in their budgets and traditionally we have seen that they tend to spend this in the end of year. So we expect and we should be first on those money at the end of the year when they wrap up their budgets. And when it comes to spring, of course, we come in some regions. We start the landscaping activities in earlier than we've done before, and in January that should be positive.
Great, a strong Q2 and Q4 then. Thank you for being here today.
Thank you. Thank you.